CDRs have been a great way to gain exposure to the US market and make some pretty massive returns at the same time. Hold on to your seatbelts, folks. This is going to be a good one. I am often saying you should not be ignoring the massive market to the south, as there is a lot of money to be made in the US market. There is, of course, a way to keep your money in your Canadian account and invest in some of the biggest US companies out there. A way to avoid worrying about currency conversions and withholding taxes and, of course, the headaches that come with them. That's right, we're talking about that financial instrument known as a CDR. Canadian Depository Receipts, or CDRs, are a fantastic option offered by CIBC that allows you to buy US stocks in fractions that have already been adjusted for currency exchange. Trading in Canadian dollars just makes it a bit easier to manage your investments and avoid all the pains of currency volatilities. In a nutshell, CIBC will buy a good amount of the US asset and put it into a portfolio. They will then subdivide it into smaller shares, which they sell to investors in the form of a CDR. With this model, a high-priced US stock becomes a much more affordable CDR. It is very much like owning a fractional share, but well, in whole numbers. They do hedge the CDRs to Canadian dollars, so they handle all of that currency fluctuations and any kind of conversions that need to happen. That's all done behind the scene. Their goal is to make it a seamless experience for us, for the investors. So what about fees? They're obviously not doing this out of the kindness of their heart. This is true. However, they don't actually have a management fee per se. There is a spread of up to 0.60%. which will provide some revenue to CIBC. That's not really that bad, and you are not likely to even notice it, to be honest. Another thing to keep in mind, though, is that any dividends paid to CIBC from the US assets will have a 15% withholding tax on them, so that will also come out before your return is calculated. In most cases, these CDRs tend to be bigger growth stocks. So that number the IRS is taking is usually very, very minimal. As you guys know, I am not a big fan of taxes. Did you know that, well, a sub to the channel is absolutely tax-free? The list I have for you today is straight up the top 5 total return CDRs that we currently have. I say currently because CIBC tends to add new ones from time to time. Currently, we have just over 50 different ones to choose from. These CDRs are not sitting on the TSX, they're actually sitting on the NEO exchange. For these CDRs we're looking at today, I will share the pricing and return data for each, but the surface data I will pull from the underlying assets, as you need to focus on their fundamentals if you want to kind of gauge what the CDR may do next. Today's list is sorted by their year-to-date total return numbers. So, without any further ado, let's do this. Kicking off this list, we have Walmart with a ticker of WMT.DE. Walmart is a huge retail presence, and with many people looking for cheaper options, they are positioned to do very well for sure. At the time of recording, this CDR was priced at $30.97. The US Walmart, they have a market cap of $569.08 billion. They are half as volatile as the market average with a beta of 0.50. Their earnings per share come in at 2.33, and we get a price to earnings ratio of 30.36. Their return on equity, that comes in at 23.46%, and we get a return on assets of 6.92%. Their debt to equity ratio, 75.36%. Okay, let's switch back to the CDR data. They currently have a yield of 1.17%. It is a quarterly dividend of 9 cents per share. CDRs have not been around for 3 years, so we're only going to look at the 1 year and the year to date. So for the 1 year, they have a total return of 35.95%. Factor in some dividends, we get a total return of 37.47%. Year to date, that return on investment comes in at 32.35%. Total return, 33.12%. That's not too shabby, especially for the first stock. These numbers are, well, they're gonna get bigger. Coming in at number 4, we have Meta with a ticker of META.DE. They did stumble with the whole failure of the metaverse, but since then, they have bounced back big time. CDR is priced at $26.66. Switching over to the US Meta, we get a market cap of 1.21 trillion. We get a beta of 1.21. Their earnings per share, 17.40. That price to earning ratio, 27.40. Return on equity, 33.36%. And their return on assets, 17.31%. Their debt to equity ratio, not bad at 25.17%. Switching back to the CDR, we do get a yield of 0.22%. It's another quarterly dividend of 2.8 cents per share. On their 1-year return on investment, that comes in at 49.78%. Sprinkling in those dividends, we get a total return of 50.09%. On their year-to-date, that return on investment comes in at 37.56%. With the dividends, total return 37.85%. Taking our third spot, we have Eli Lilly with a ticker of LLY.DE. These guys are drug manufacturers, and they develop, manufacture, and market a whole assortment of diabetes, obesity, and cardiometabolic drugs. This CDR is priced at time of recording at $31.80. Their US Eli Lilly has a market cap of $772.07 billion. Another really nice looking beta, 0.41. Their earnings per share comes in at 6.77. They've got a really big price to earnings ratio at 126.66%. Their return on equity, that's coming in at 50.75%, and they have a return on assets of 12.60%. Their debt to equity ratio, it's big, 204.28%. So that one has me a little bit concerned, a little bit, just a little. Switching back to the CDR, they have a dividend yield of 0.41%, quarterly dividend of 4.9 cents per share. On their return on investment for the 1 year, that comes in at 45.74%. Adding our dividends, we get a total return of 46.38%. On the year to date, that return on investment comes in at 40.34%. Factor in the dividends, we get a total return of 40.76%. With the explosion in popularity of weight loss drugs, this company has had a great year and may just keep growing as some of those customers keep, well, shrinking. In our almost top spot at number 2, we have Broadcom with a ticker of AVGO.NE. This is a company that designs, develops, and supplies semiconductor, enterprise software, and security solutions. The CDR is priced at time of recording at $37.93. The US Broadcom has a market cap of $732.44 billion, a beta of 1.19, so just a little more volatile than the market average. Their earnings per share, that comes in at 2.33. That price to earnings ratio, 67.53%. Their return on equity, 22.23%, and a return on assets of 7.43%. Their debt to equity ratio, it's another high one at 166.03%. Switching back to the CDR, they do have a dividend yield of 1.30%. It is a quarterly dividend of 12.5 cents per share. Their return on investment for the 1 year, it comes in at 84.75%. Add the dividends, we get a total return of 87.14%. Their year-to-date, that return on investment comes in at 45.88%. Sprinkle in the dividends, once again, total return 46.85%. They have benefited big time from the AI surge, though perhaps not as big time as the next CDR. In our top spot, at number 1, we have NVIDIA with a ticker of NVDA.DE. When you think AI, you almost always think of NVIDIA's chips and software that has made a lot of it possible. The CDR is priced at $27.78. The US NVIDIA has a market cap of $2.90 trillion. They've got a pretty volatile beta of 1.68. Their earnings per share, that comes in at 1.71. Their price to earnings ratio comes in at 68.96%. They have a return on equity of 115.66%. Return on assets, 49.10%. And a nice looking debt to equity ratio of 22.87%. Let's switch back to that CDR. They do have a dividend. It is a yield of 0.09%. So we're looking at a quarterly dividend of 1 cent per share. Their 1-year return on investment, that comes in at 162.08%. Factor in a little bit of dividends, we get a total return of 162.12%. On the year to date, that return on investment, 143.04%. Total return, 143.07%. It is hard to overhype what NVIDIA has done. And I know some people are just waiting for the AI bubble to pop. But I don't see that happening this year. So there may still be more impressive moves left in NVIDIA's tank. If you are interested in any of these CDRs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Loblaws, and I will see you in the next video.